So today I'm going to cover off on 3 key points for you. The big opportunity that we see in small caps today, similar to some of the other managers that have been before, but more importantly, how we at Firetrail go about approaching that. Secondly, my personal favourite part of the presentation, one high conviction stock idea, and then finally, the increased opportunity that we see in alpha available from capital events. So let's get stuck in. Now, if you're anything like me, on a Sunday night, you'll wrestle a child to bed and then you'll sit down on the couch. You'll open up the financial press in anticipation of a great week ahead. And over the last year, I've been reading an article by some overpaid strategist, and it will go something like this. The S&P 500, or the US large cap index, it reached record levels of concentration, record highs. It was driven by the Mag 7. And the top 10 stocks in the index, they now account for 35% of the total. But of course, for us Australian investors, this level of concentration is nothing new at all. In fact, it's not even scary. The top 50%, or the top 10 stocks rather, in the ASX 200 account for a whopping 50% of the total market. So it then follows, if you're going to consider an allocation of your client's money or your money to the ASX 200 index, what really matters is the outlook for these top 10 stocks. Now, over the past 3 years, as we all know, and to some frustration as a small cap analyst, this has been great. We've seen the big 4 banks, we've seen Wesfarmers continue to reach all-time highs. I'm acutely aware of this because my mum, she has one single direct shareholding, and it's Commonwealth Bank. And yeah, of course, I've been telling her to sell it for 3 years. So that's something that I have to put up with every single family dinner. But on a more serious note, what is the outlook for the ASX top 10? Well, fortunately for our investors, I'm not a large cap banking analyst, and I hope I never will be. But what I do know is that the single greatest determinant of future returns is the price that you pay for an asset today. And when it comes to the top 10 stocks in the ASX, every single stock, bar CSL, the one exception, is trading at a material premium to long-term averages. So the large cap market is expensive. It's incredibly concentrated. What I'd like to do now is to invite you or get you to consider a scenario. And that is the next 3 years are not the same as the past couple. These top 10 stocks, they're not a tailwind to returns. In fact, they're a headwind. How would your portfolio perform? And how would your client's portfolio perform? So if you believe this clearly self-serving small cap manager sitting up here telling you that the large cap index is both expensive and concentrated, how does the small cap index compare? It's good news here, guys. Surprise, surprise. The small cap index is not at all concentrated. The top 10 stocks, only 14% of the total index. Not only that, but it is incredibly cheap. I was actually amazed when our product team sent me through this data. It was better than I could have hoped. The ASX Small Ordinaries Index isn't among the cheapest in the world. On a growth adjusted basis, which is the PEG multiple displayed here, it is the cheapest. Our large cap mates, with my mum's Commonwealth Bank sitting at the top at 8% index weight, that's on 4.7 times, the most expensive index anywhere in the world. Small caps are diversified, they offer a highly attractive value, and in our view, now is the right time to consider an increased allocation. Not only are small caps one of the cheapest, and in the case of the ASX, the cheapest index globally, in the case of active small caps, they are the highest returning. This chart here shows the median active small cap manager in Australia has returned 11% per annum post-fees over the very long term, outperforming our large cap mates and the large cap index as well. Now, I often catch up with mates, it's always high school mates, this conversation, and they say to me, Fisty, you work in investment markets, you're an investor, you do that money stuff, tell me, is now the time to invest? Should I get in? I always disappoint them with the answer and I say, I have absolutely no idea. What I do know is that over the past decade or so that Ellie and I have been looking after this strategy, we've returned around 12% net excess post-fees above the market per annum. So unless you think that the market's going to decline by 20% tomorrow, market timing doesn't matter. In fact, we think market timing is a mug's game. The most important thing is the strong excess returns that a good small cap manager, like the 4 that you've seen already today, can deliver. And what that does to compound wealth over the long term. I'll say it again, market timing, forget it. All right, so the key question then is, how do we at Firetrail go about generating that 12% excess per annum. In a nutshell, we employ sector specialists to invest right across the market. Small cap is a land of great opportunity, and you've heard that many times today. It's particularly inefficient. But where we see the most inefficiency or the best money-making ideas, they're in two sectors. They're in healthcare and they're in resources. Now, fortunately for myself and our investors, my co-portfolio manager, Ellie, who is pictured here having some sort of diagnostic imaging scan done, is a qualified immunobiologist. Now, I've worked with her for several years. I still haven't admitted to her that I don't quite know what that is. But what I do know is that when it comes to healthcare stocks, Ellie is one of the very few people in the market that can understand them at a fundamental level. And not only that, but most importantly, translate them through into an actionable investment insight or something that we can use to make money for our clients. Now, when it comes to resources, I didn't think you'd believe me, so I brought along some photographic proof, given that I do have keyboard hands at the moment. But prior to working in finance, I did spend several years working for BHP and Rio, both above and below ground, as an engineer and geologist. Now, what does that mean for our clients? Two things. Firstly, stronger excess returns. And secondly, if we do our jobs well, more consistent excess returns too. And that's through using our unique skill sets to find opportunities where most people just aren't looking. And this next slide is some quick proof of that. All right, so the best part of the presentation. One high conviction idea. I'm a bit nervous about this one because when we do these sort of pitches, we normally pick a stock that has two attributes. Firstly, it's lowish risk, it's got a pretty high hit rate, and secondly, it's been in the portfolio for a while, so we know management, we're comfortable with it. This stock has neither of those attributes, so I'm a bit worried about it, but we'll see how we go. I want to pick up on something Marcus said earlier in his presentation, and it's something we definitely agree with. Crowding is just a massive feature in the market at the moment, not only in large caps, but in small caps as well. Investors are focused on stocks that have what we call perceived earnings certainty. Think about stocks like on the top right of this chart, the platform stocks that many of you would be familiar with, like Hub24 and Netwealth, AUB Group. These are all great companies. They're growing strongly. They're in structural growth markets. They have great competitive positions. They have great management teams. And as a consequence, they're super well owned by small cap investors and retail investors alike. Over the past 12 months in particular, we've seen investors bid up or expand the multiple that they're willing to pay for $1 of earnings from these companies with this earnings certainty. On the other side of the equation, we've got the stocks that no one wants to talk about. These stocks have more volatile earnings, they're harder to forecast, they may have seen downgrades, management changes, you know the drill. Two of these stocks in our portfolio at the moment, unashamedly, are Viva Energy and corporate travel. And I want to spend some time talking about corporate travel today. But it's this myopic focus or singular-minded focus by investors on short-term earning certainty that has opened up a massive valuation opportunity in high-quality cyclicals, and we hold several of these in our portfolio. All right, so Jamie Ferris is staring at me there on the screen. Now, I'll be the first to admit, and I won't beat around the bush, 2024 has been a terrible year for corporate travel. I'm sure it's one that this man here, Jamie, would rather forget. He's the founder and the CEO. It's been marred by a number of one-off contract losses or issues, let's say, in the UK predominantly. And there's also been a string of miscommunication with the market. I think I'm being pretty kind when I phrase it like that. In response, we've seen FY25 earnings estimates fall by 35%. The stock has been smashed. It's been absolutely carted out. It's down over 55% relative calendar year to date. But that is backwards looking. Let's look forwards. Corporate travel has a number of qualitative attributes that we absolutely love. Firstly, it's founder-owned, it's founder-led. Jamie owns around 12% of shares on issue. Secondly, it exists in what is a fragmented and fast-growing market. Yes, the corporate travel market is not dead, and case in point here is Greg, who's flown from Canada to see us all here today. Face-to-face meetings still matter. In this growing and fragmented market, corporate travel has a number 4 position, and we expect that they'll consolidate the market over time. Corporate travel, it generates a massive amount of cash. It's got an all-in free cash flow margin of around 15%. Corporate Travel runs a very conservative balance sheet. In fact, it was one of the only companies globally not to raise equity during the COVID pandemic. We think that's seriously impressive management. It's got $180 million of net cash on the balance sheet compared to a $1.7 billion market cap, and it's undertaking an aggressive $100 million buyback as we sit here today. Most importantly, we expect Corporate Travel will grow earnings at 10% per annum over the next 3 years. So that's the qualitative stuff. All sounds pretty good to me. Let's chat on valuation. Now, we're a bit old-fashioned at Firetrail. Many fund managers or investors will openly admit that they don't care about valuation anymore. All they do is chase earnings revisions. To us, that does not make sense. We are very disciplined in our valuation approach. What I've done here is give you a trend line, and that trend line is the valuation multiple that the market is willing to pay currently for every single stock or every single industrial stock in the ASX 300. For 10% earnings growth, we typically see the market value that stock on around 24, 25 times earnings for a good quality industrial business that has the attributes that I've listed here on the left-hand side. At the moment, Corporate Travel is languishing. It's trading on a multiple of 14, 15 times FY25 earnings. We expect that over the next several months and years, as Corporate Travel de-risk this earnings profile and restore market confidence in what is a great business, the multiple will re-rate, as you can see by this great animation here. So Corporate Travel is uncomfortable, but history has taught us, and in my experience at Firetrail, that uncomfortable opportunities sometimes are the best. To beat the market, you need to be both different and right consistently. And that's why Corporate Travel, we believe, is a compelling opportunity for our investors. Alpha from Capital Events, and I don't want to get all the brokers in the room too excited, but this is something that we're very positive about at Firetrail. And I want to start by letting you in on a secret. Equity capital market events like IPOs, placements, entitlement offers, they are an unfair advantage, and they're an unfair advantage that's typically only available to small cap institutional managers. And I personally believe that they're responsible for a large component of those really strong long-term returns that I showed on the first slide, that 11% per annum in the green. But it has not been good news for capital events over the past several years, as any brokers in the room will attest to. In fact, we've seen the opposite. We've seen companies disappear from our index. SDA Health, Silk Laser Clinics, my favourite, Azure Minerals, wish I had it back, and CSR. They've all disappeared from our market, all taken out at great premiums. Now, that's been amazing for short-term investor returns, but what it's also done for us is it's reduced the number of opportunities available to us. Fortunately, just in the last few months, we've seen that turn around sharply. We've seen an increase in the number of IPOs and an increase in the number of capital raisings as well. We've participated in over 17 different capital raises just in the past 3 months, and on average generated a return of 15% in the first week, on average for each one of those raises. We participated and were in fact one of 3 funds to participate in the Guzman Gomez pre-IPO, and so far we've realised a return, or an excess return, of 126% on our investment, and we still think there's plenty more to go. We're optimistic that the last couple of weeks, the last few months, it really represents a turning point in equity capital market activity. And for small cap investors, this can be a huge tailwind for returns and really supercharge them. Now, I did this presentation last week, and at the conclusion, I had a gentleman come up to me, a financial advisor, and he said, "It's all well and great to talk about returns and ECM, but what exactly does supercharge mean?" Being an analyst, I thought that is a fair question. So I went back to my hotel room that night, pulled out the laptop, pulled out 15 years of data from this small cap strategy, and looked at the return component for each financial year. On average, in a good equity capital market cycle, we've been able to deliver around 6 to 7% net excess to investors just from ECM alone. So as you can see, it's highly material, and we hope that the last couple of weeks or the last few months are an indication of what's to come. So in conclusion, we've touched on the big opportunity in small caps today, and hopefully you are as excited as I'm about the outlook. So please sell some Commonwealth Bank shares and invest in some small caps. Corporate travel management is uncomfortable, but we see it as a great opportunity. It's uncomfortable, but it's going to be compelling on a 3-year view. And finally, we've touched really briefly on what is a great emerging opportunity in the alpha available from capital market events. So thank you for your time. We're very proud of the returns we've been able to generate for our investors. We're working very hard to ensure it continues, and we'd like to invite you to invest alongside us. Cheers.